Welcome to Two Beans in a Pod. Today, we are doing a deep dive into a concept that recently emerged from the administration and was pretty quickly confirmed by a housing director. We're talking about the 50-year mortgage.
It's a really big idea, and it sounds so simple on the surface. Just stretch out the loan, lower the payment. But the implications for, the financial future of young Americans and even the whole housing market, they're monumental.
Right. So our mission today is to unpack this whole thing for you. We want to understand the math in plain language. Is this a genuine solution to what everyone agrees is a broken housing market? Or is it more of a hidden trap, especially for young people trying to get a foothold?
Well, to really get it, you almost have to look back 90 years. The 30-year fixed-rate mortgage, the one we all just assume is normal, it wasn't standard until after the Great Depression.
I think most people don't realize that. Before the 1930s, what was it like?
It was incredibly risky. Loans were maybe 5 to 15 years long, and they often had these huge balloon payments at the end.
Meaning you had to suddenly come up with, like 40% of the home's price after just a few years, or you'd lose everything.
Exactly. Homeownership was volatile. It was for the very secure. Then FDR's New Deal, specifically the Federal Housing Administration, it completely changed the game. The government started insuring these longer fixed-rate loans.
And that's what made the 30-year model the standard.
Stabilized everything. And it really did make home buying accessible to the middle class for the first time.
So that history shows government intervention can work, but it has to have a real long-term benefit. Now, we're looking at moving those goalposts again. Let's start with the hook. What's the immediate appeal of stretching that loan out by another 2 decades?
The appeal is it's pure immediate affordability. With home prices being what they are, this is really a play to lower people's monthly mortgage payments. It gives buyers an immediate cash flow break.
Okay, so let's run the numbers just on the principle to see the raw mechanics of it.
Sure. If you take $400,000 of principal debt, right, over 360 payments, that's your 30 years, that's about $1,111 a month.
Okay.
Now stretch that same $400,000 over 600 payments, the 50-year term, and the principal part drops to around $667 a month.
That's a huge psychological drop. But let's bring in the real world now, with interest. How much cash does this actually save someone in their wallet today?
Right. So let's use a typical loan, say $320,000 at a 6.5% interest rate. Your 30-year monthly payment is about $2,022.
And the 50-year?
That drops down to roughly $1,800.
So you're saving about $220 a month. An 11% reduction. That's what, $2,600 extra in your pocket every year? I mean, when budgets are breaking, that feels huge.
It absolutely does. And that $220 is what's driving this whole policy conversation. But that leads us straight to the critical question. What is the long-term price for that 11% discount?
This is where it gets a little scary. It stops feeling like relief and starts to feel like, financial servitude.
Mm-hmm.
Walk us through the total interest burden on a 50-year term.
Well, this raises that fundamental question of total cost, right? And the bank's profit. Let's stick with a $400,000 loan at 6.5%. On a standard 30-year term, you pay $510,178 in interest.
So you're already paying more in interest than the house was even worth to begin with.
Yeah. Now look at the 50-year term. The interest you pay over the full life of that loan, it balloons to $952,921.
Whoa.
You end up paying a total of $1.35 million to own a $400,000 house. You're paying almost double the interest just for those extra 20 years.
That's nearly $1 million in interest. So, okay, it seems obvious why a bank would love this.
Mm-hmm.
What does it do to their risk? That's the other side of the coin.
The risk equation is completely different. The sources we looked at, they really emphasize that in the early years of a 50-year mortgage, next to no principal is paid off.
So for the first decade, pretty much every dollar you send them is just going straight to interest. You're just renting money. You're not actually buying equity.
Precisely. And this is a massive headache for the bank's underwriting process. That's, their formal risk assessment before they approve a loan. Their process has to be extremely confident that the house itself won't go down in value for the first 10, maybe 15 years.
Because if the buyer defaults in, say, year 8, the bank takes the house back, but the loan amount is still almost what it was at the very beginning.
Exactly. The collateral has to be worth more than the loan. So this dramatically slows equity growth. If you want to tap your home equity or even just sell the house without having to write a check back to the bank, you are stuck waiting years longer.
And the sources pointed out that the median age for a home buyer is now 59. A 50-year mortgage means that person is 109 years old before they pay it off.
Yeah.
It's debt that outlives you. Which brings us to the critical market question. The stated goal is affordability, right? Especially for the younger generation. But will this proposal actually make housing any cheaper?
And that's what's so fascinating. The economic reality, just how markets work, it actually works against that goal. If you make borrowing artificially cheap, and stretching the term out definitely does that, the price of the asset just adjusts upward instantly.
Because all of a sudden more people can afford the monthly payment, so there's more competition.
Correct. The market doesn't price a house based on what it costs to build. It prices it based on the maximum monthly payment the pool of buyers can tolerate.
Okay, let's use that extreme example to make it clear. If we had like a 100-year mortgage where the payment was only $200 a month, what happens?
Millions more people could afford that payment. So that mass buyer tolerance would drive the price of the house up instantly. The more realistic take is, if a 50-year loan makes the monthly payment 10% cheaper, home prices will likely rise by about 10%, almost overnight.
So your $400,000 house is now a $440,000 house, and the monthly payment is right back where it started.
Exactly. The market prices the monthly savings away, the affordability benefit gets neutralized, and all you're left with is the exorbitant, nearly $1 million interest bill.
So longer mortgages don't solve affordability, they just fuel asset inflation.
Right. It lets sellers and lenders extract more capital from the system. It mainly benefits the people lending the money. And it also benefits large institutional investors, like Blackstone or BlackRock. A lower monthly payment lets them pay more for an asset, which pushes prices up even further for a regular family.
Okay, before we move on to what some real solutions might look like, if you're finding this breakdown of market mechanics useful, please remember to like and subscribe to the show. It really helps us keep these deep dives coming. All right, let's pivot. Is there any scenario where a 50-year mortgage makes sense for a buyer? I mean, the math looks pretty terrible for the average person, but is there a strategic play here?
Yes, but only if you approach your money like a machine. With perfect discipline. It all comes down to the time value of money argument.
And what does that mean for our listeners?
It means $1 today is worth more than $1 tomorrow because you can invest it. So if you are that incredibly disciplined robotic investor and you take that $220 a month in savings and you invest it consistently for 50 years at, say, a 7% return, that would actually grow to around $1.2 million.
So in theory, that disciplined investor could generate enough on the side to pay off the extra interest and still come out ahead, stretch the debt, invest the difference.
Precisely. It's how many wealthy families think. They use cheap debt as a tool to get cash into higher-yielding assets. But the flaw here is that most of us are not robots.
Right. The human factor is messy. 50 years is a lifetime.
Life is sloppy and chaotic. People lose jobs. They have medical emergencies. There are recessions that cause panic selling. Most people just don't faithfully invest that $220 every single month for 5 decades straight.
And there's a huge psychological value in having a finish line, a day when you're actually debt-free.
For the non-robot buyer, the 30-year mortgage is just the safer bet. You build equity faster, and you get the security of being debt-free in your own lifetime.
So practical advice would be, if you plan to live in the home for, say, less than 10 years, a longer loan term might be viable. You can sell or refinance before the interest really piles up. But if you plan to keep this loan for the long haul, the amount of interest is just a huge turnoff.
Absolutely. So the question remains, if this doesn't solve affordability, what would?
We have to address the cause, not just the symptom of high payments. What do the sources say are the real structural changes we need?
The consensus is that the root cause is a lack of supply. So the alternatives focus on inventory. First, make it easier to build more homes cut through some of the regulatory hurdles. Second, change zoning rules to allow for more density, especially in high-demand cities. That's politically tough. Existing homeowners fight it tooth and nail, but it's necessary.
That's the long-term fix. What about freeing up inventory that exists right now? That carrier rate idea was interesting.
Yeah, that's gained a lot of traction. The idea is simple. Let homeowners who have a low interest rate, like 3%, carry that rate with them to the next house they buy.
That would unlock the market overnight. So many people are trapped in their homes because they can't trade a 3% mortgage for a 7% one.
Exactly. They'd move, freeing up those starter homes for younger buyers. And finally, a lot of people are talking about limiting institutional investors from buying up huge numbers of single-family homes so that inventory goes back to families.
All of those ideas get at the core issue: inventory and supply. The 50-year mortgage, by contrast, feels like a debt gimmick that helps the financial system more than the homeowner.
It really is a trade-off. You get a modest, maybe even fleeting reduction in your monthly bill, and in exchange, you get a massive near doubling of the total interest you'll pay over your lifetime. It doesn't solve high home prices, it just masks them.
So as we close out, here's a final provocative thought for you to think about. When you're talking about a 50-year debt commitment, you are betting on the financial and political stability of a specific location for half a century. You have to think about risk way beyond just the next decade.
Mhm. And when you factor in the growing polarization of, say, regional politics or the long-term impact of things like redistricting, you realize housing stability is deeply tied to political stability. Taking on debt that lasts that long means you have to be confident that the local governance and the economic future of your area will stay strong for the whole duration. That becomes a huge part of the financial equation.
Thank you for listening to Two Beans in a Pod.